The stock market is going up as if the Federal Reserve just announced quantitative easing, but I thought they increased interest rates. Well, I'm about to show you why not only could we be entering the next phase of a bull market, why this could actually be creating the next wave of inflation. We've got a lot to cover. Let's begin right here by taking a look at Michael Burry. He made this comment, sell. Now this was on January 31st. As always, he proceeded to delete his Twitter account immediately after that. So we have seen since that tweet, the market going up significantly because the market believes that there is nothing stopping it from going higher at this point. We've got higher interest rates. We've got some quantitative tightening. However, financial conditions are at a point in which they're not really restrictive at all. So the market at this point believes nothing can stop it. That, of course, is dangerous because when we look at risk assets, this could be starting to create a next wave of inflation, the tsunami of inflation that is very difficult to stamp down on. This is not what we're experiencing so far. We're talking about the next wave, always much more difficult. Look at the 1970s as an example. Now, this is what I was talking about back in September. I'll show you from September as well as into October. This is the quote. Some are starting to say that the bottom of the stock market rout will be in October. Of course, this is last year, 2022. Economy will be weak into next year. However, we'll see. So anybody who took advantage of that information, I also showed you the charts around that time. And so if you were able to basically see that as an opportunity, that is very good. Congratulations on that. And basically what we're looking at here is just one of many quotes that I'll give you in a second, but just to highlight the fact that the market was oversold. The market does not care about actual fundamentals, and it is only looking for a few basic things, and that is how much risk are they willing to take. The market always prices in perfection. They expect that if there's any sort of turbulence in the market, that the Federal Reserve is going to step in. And right now, we've seen Russia, Ukraine not really be an impact. We've seen what's happening with China and Taiwan not being an impact at all. Nothing phases this market because of the trillions of dollars that are flooding it, that are absolutely going through and, in my opinion, creating this mess in the first place. So that was in September, approximately, I believe it was late September. And looking at the next aspect here, I have it here, pivot coming. Okay, this is literally what I said. Pivot coming. This is entirely absurd and will result in the rapid destruction of the currencies. This flip is happening even faster than the most bullish had expected. I will cover it in tomorrow's video. Stay tuned. Get ready to buy the most garbage, worthless stocks because they're going to go up as the currency evaporates. I literally said this, I documented that, it's here on the channel for you. There are some others in here, but I literally said this. We're talking about that September, October timeframe exactly at the bottom. So when people point to me and they suggest anything about what I have said, I put it in black and white. I didn't, obfuscate this. I didn't, cover this and then, highlight that. I literally wrote it in text format so everybody could see precisely at the bottom. It is not difficult to see these things as we move through the cycle and where you can be able to determine when it is the right time to put your money in. So anybody who took advantage of that information, I wanted to put it there for you right here today. Now, I wanted to show you what is also happening right now with the Federal Reserve increasing interest rates by 25 basis points. That was the big deal, right? Well, before they did 75 and they also did 50. Now they're down to 25 basis points, indicating that they would do more. So I believe at the next meeting, they'll probably hike another 25 basis points. We will have to see. At least that's what we're being told. And inflation will likely, on their metrics, their inflation metrics will probably decline a little bit more. However, if everything stays hot, if we get into this zone where everybody's just throwing all their money in, nobody cares about this, jobs market stays hot, that could fuel a second wave of inflation. Gotta remember that. Bank of England chief tempers talk of a pause or a pivot in rate hikes. So while they did remove the word forcefully from its forward guidance, they wanted to make sure everybody knew that we're not done. Well, that's not what the market does. The market prices in perfection. They priced it already in. Anyway, the ECB, on the other hand, increased their interest rates by 0.5%, 50 basis points. And markets didn't really, respond negatively to that because the other central banks are doing so. But they basically said, yeah, we're probably going to have to be done here. If not this time, next time, and so on. So they're all doing this now. Bank of Canada is pausing. Everybody's basically either pausing or saying that was it, we're done. So we'll see what happens globally. All central banks are now going for the U-turn. And this is a very, very dangerous policy, of course, but that's your currency that you got to worry about. They don't have to worry. They really don't, because these groups are trying to actively create a problem. The U.S. Fed's smaller rate hike brings dollar strength closer to its end. So we need to see what's going to happen, of course, when you relate the two currencies, comparing the US dollar to anything else. It had done so well. It was so strong for such a period. And now that could be changing. We'll see the relentless dollar strength. We will see an end to it. I don't know when that's going to come. Is it necessarily right now? Or is that something that will take some time as other currencies kind of get valued higher? I really don't know. However, anybody who's earning US dollar right now and doesn't live in the US has done very well, let me tell you. So let's talk about the next aspect here that I believe is really important, and that is tighter credit conditions. So while we've seen the financial conditions index kind of looking broadly at financial conditions, this shows us when you could see consumer credit, that is the black line, showing us that things have tightened. Okay, so it's a little bit more stringent on the rules, and I'll give you more in just a second on that. But I also wanted to highlight revolving credit. So think about like credit card debt, for instance, that has been rising to highs we've never seen before. So, I mean, what was it, 19.9% now? The last I checked, the average credit card interest rate is 19.9%. And so these companies are starting to tighten up their belts a little bit. So this chart basically breaks that down. But in general, senior loan officer opinion survey on bank lending practices all throughout, basically saying the net percentage of respondents tightening standards for, this is, commercial and industrial loans, small firms, consumer credit card loans, and so on. All of them are tightening. Okay, that's all you need to know. So they're trying to be a little bit more stringent on the rules, but they are never going to be able to actually resolve anything or prevent anything. We need to make that clear. Mortgage rates dropped to the 5% range for the first time since September, dipping just under 6%. They were over 7%, and now they've fallen below 6%. So this is going to spur more investment into real estate, both from the investment side, like when we're talking about actual investors, and people who are just trying to get their home. They're saying, oh, now's the right time. So they're going to be getting in here because they don't want to miss the boat. That's the way this works. So it's constantly never allowing to come to a point of realism or finding a balance. It's always about putting maximum pressure on the buyers. And this is going to be, of course, very, very bad in the longer term, but that's what they want to do. Average monthly tracker mortgage payment jumps by nearly £50 following rate hike. So for people, but I mean, this is everywhere, basically, that they are paying a lot more. Anybody who was on variable mortgage rates had been getting pounded, absolutely hammered over the last year, basically, as rates had been rising. So we see that effect on the real economy. I talked about this at the beginning, say, yeah, okay, stock market could be bottoming out here, but the real economy, not so good, not so good at all. Corporate America continues to splurge on its own shares, fueling the New Year rally. Indeed, in the first month of 2023, announced buybacks more than tripled to $132 billion from a year ago. That is the highest total ever to start the year. So if you want to know where all the money's coming from, and yes, retail investors are doing the most investing they've ever done ever. This is like the most ever. at that time, you look at this and see that, yeah, actually the biggest buyers since 2009, the biggest buyers of stocks have been the companies themselves. And right now today, they are buying more than ever before. So you want to know why this is happening. The stocks are buying themselves. It's a weird kind of scenario, but that's what we got to deal with. This is the reality of the situation. I bring the data here on this channel. Have you ever been to this channel before? Is this your first time? You got to hit that subscribe button, okay? Because I bring you the latest and greatest without any of the political nonsense and garbage, and I explain things in plain English, okay? Put call ratio. Essentially, what we're looking at here, the puts are bets. If you want to just simplify it, puts are bets that the stock market will go down. Calls are bets that the stock market will go up, and puts right now are not in favor. So the money is being put on the stock market going up. The weird thing about this is like, it's usually the exact opposite. So when there's too many puts, it's usually that, okay, everybody's bearish. That's a signal the market's going to go in the other direction, and vice versa. We'll see. Call volumes have risen, and again, put volumes going down. So there's just less money going into puts right now. Nobody wants to bet against this right now when we're seeing so much enthusiasm. There is no fear. This market doesn't have any fear. And you look at the yield curve inversion that's taking place. What is a yield curve inversion? Well, just imagine this. I always use the analogy. If you're going to take on debt that's 30 years versus debt that's 3 months, you would think that you get a better return on the 30-year than you would on the 3-month, right? Because you're taking a risk, 30 years. However, that has flipped around. So the short-term debt is actually netting more than the long-term debt. This happens when we are entering a recession, and right now it is the most inverted ever. That's the 3-month and the 18-month. And the reason why this is being used is because this is one that the Federal Reserve looks at. So they're looking at that. Very important, okay? Chip stocks, so semiconductor stocks, rally on optimistic AMD earnings and the Fed's signal that inflation is easing. I've talked about this before, just looking at semiconductors because they are a bellwether of what's happening in the economy at any given moment, okay? So we can also look at the expectations of recession. I think it's important just to understand that when you look at the data itself, it tells a story, and that's what we've seen here today. I hope that this was useful to you. How I showed you back in September, back in October, I made the point very clearly multiple times, like more than 3 or 4 times, both in the videos and on those posts, because I wanted to know that this was going to be the factor, and I could reference it months later, and here we are today. So I hope you were able to take advantage of that. You know, you got to hit that thumbs up. That was interesting, to say the least, to point it out like that, and hopefully I was of some value to you. If I was, hit that subscribe button down below. Let me know what you think in the comments, and I'll see you tomorrow. Take care.